But yes, of course, we have been sharing the rally that Nifty and Bank Nifty has witnessed from the lower levels of March, and Kunal believes that there could be some more upside. But let's take the discussion forward with Rupen Rajguru, Head of Equity Investment and Strategy as Julius Baer. Hi Rupen, good to be speaking with you. A very good afternoon. And Rupen, firstly help us with your take on the overall market sentiment, because 2025, there has been a change in the narrative, how you look at the emerging markets and especially India. The March has been quite a volatile month for us, though we are cheering the recovery from the lowest level. But the harsh reality is that in this mid end of the market, there are pockets where we might not see the stocks recovering back to those 2024 high levels. Give us your sense on the markets right now. Is this the time to deploy more or rather be selective?
Okay, hi, afternoon. Purely from a market perspective, in the very short to near terms, sentiment and liquidity determines the market movement, and and both of these change very fast. So, as rightly, I think just earlier your colleague was pointing out, probably on March of 4th, we were worst as far as the sentiment and liquidity was concerned. So while liquidity has not changed, but definitely in last 2 weeks or so, sentiment has changed. And why has the sentiment changed? Purely because I think one of the key thing which was ailing uh, emerging markets and India in particular was strong dollar. So now in last 2 3 weeks, it is very clear where the way US and President Trump is looking into that the dollar is something which is going to be weakening, and which is what we are witnessing, and that has led to improved sentiments towards the liquidity as far as the emerging markets are concerned. Coming back to the main point, while the shorter term is determined by liquidity and sentiment, which at a margin has changed in last 2 weeks or so, fundamentals drive the market over longer term. And the key reason why the markets has witnessed correction was, the significant deceleration in the earnings. So while the earnings growth was pretty strong till FY24, that earnings growth has come down to 5% for first 9 months. And there are reasons attached to it, be it slowdown on expenditure on the government side, be it excessive tightening from the RBI side, and at the same time the sentiment specifically on the urban side, the urban consumption being a little bit muted. So what's happening at a margin now? All the three factors are reversing. We are seeing government coming back and spending. So we saw record spending on the capex side by government in the month of December. January was better on a YOY basis, and RBI clearly has now given indication to the market that it is ready to support with liquidity. We have seen a lot of measures to support liquidity. Almost 7 lakh odd crores of liquidity has been infused. At the same time, on the regulatory side also, they have given indications that now they want to loosen a little bit of tighter regulation which they had put specifically on lending towards NBFC and the retail lending side. So that is changing, and plus budget has given a boost on the consumption by way of tax relief. So all three factors are changing, which probably from a 5-6% earnings growth, what we believe in FY26 will go back to 12 odd percent earnings growth. So hence we are seeing a classic bottoming of the market, and recovery will be slow, will not be as significant and fast as what we have seen in the previous cycle, but probably market looks into the rate of change, and at the margin FY26 is going to be significantly better from an earnings perspective vis-a-vis FY25.
Right. Hi, Rupen. Good afternoon. This is Ankita also joining in. So a couple of things that you mentioned there, cooling off of the dollar index. Of course, that is sentimentally a very positive news for emerging markets like India. And also, the fact that we have now, we're near the bottom, or we have, bottomed out. But I want to talk to you about this mid space. Have we really bottomed out as far as the small and the mid caps are concerned? We have seen a significant drawdown in the last few months. But is the froth really out? Does it look ripe in terms of valuations to start investing or start putting your money as far as small and mid caps are concerned? Because as an investor, you want to make a wealth, and the money is really, the kind of returns that small and mid cap gives you, that kind of returns, you don't expect that to come from large cap. So is small and mid cap really gone through its drawdown, and now it's time for us to start looking at pockets of value?
Yeah, hi, afternoon, Ankita. So SMIDs, while it's like a pack which we typically measure or we talk about, but there is huge variety of companies within SMIDs. So while at an index level, valuation will clearly point out as we speak, the mid cap index is at a valuation which is at a significant premium to Nifty, and the small cap, which was historically trading at a discount to Nifty, is now at par or closer to Nifty valuation. So from a pure index valuation perspective, we don't see that value as a pact. At the same time, we have to be aware of it is what happens, Ankita, is that typically when we are in a rally and which which was induced by liquidity or a lot of domestic liquidity, so the entire pack goes up. But the globally, when the what you call the risk premium changes, the SMIDs gets impacted the most. So that risk premium change happened probably in last 3 months, and hence we saw the impact of that happening. But to answer your question, will we see a one-way rally in the SMIDs? Probably answer is no. Have we seen the bottom of SMIDs? I would say in majority of the stocks, yes, because on an average, SMIDs, as you rightly said, on an average, they have corrected 25-30%. But the upside now, because the big chunk of earlier returns came because of re-rating. So now re-rating is not happening because we are already at a high valuation. Individually, there will be pocket of opportunities which would be there. So I would not paint the entire index, the SMIDs there by a single brush, but there definitely are pockets of opportunity which are there within segments, be it certain segments on the NBFC side, certain segment on the cement side. Individually, opportunities are there. And I think one has to be so this year or next 18 months, we will clearly see a lot of bottom up ideas which will do better rather than the entire pack which moved up in last 3-4 years, because there was a lot of momentum around that. And earlier, the starting point was undervaluation, and now the starting point is not undervaluation.
But Rupen, before we let you go, I just wanted to check from you that which are the sectors that you are bullish on right now, and we believe that NBFC and OMCs are some of the picks that you believe that can do better. But other than that, Rupen, help us with your take on the power counters as well and the sector overall. What's been happening there, and is this a time to look at some of the power companies?
Yes. Yeah. Hi. So, as you rightly said, we do like financials, and tactically in the probably next 1 or 2 quarters, NBFC, what we believe would outperform the private banks, because they are better placed in an environment. If the interest rates are going to go down, they have a better positions from a NIM perspective, and plus RBI is clearly wanting growth to come back, and OMCs, of course, for the reasons wherein we believe they are trading at a valuation which are below its long-term average, and with lower crude price and better marketing margins, they are well placed. Coming specifically to the power sector, the entire power value chain, we saw a big re-rating between 2021 till 2024, and then in last 3-4 months we saw significant corrections. So while from a thematic perspective, we continue to like that segment, and within that segment, we like the T&D space because that's where we believe there is relative value. So the utility which is there on the transmission side is what we like, and then there are individual companies in the T&D space. Somebody who's focusing on the HVDC side and some of the other equipment side is what we like. And because the correction has been quite significant, and on a relative basis, we believe over next 3-4 years, the earnings visibility is going to be pretty strong, and the balance sheet of all these companies are also pretty good. So within the power space, we like the T&D space.
All right, Rupen, thank you so much for giving us your picks, sectoral preferences, and more on the markets. Thank you so much for taking the time out and joining us.
Thank you.
If you like this video, then like, share and subscribe to ET Now.